What's up, everyone? It's Caddy with MoneyVest. So wanted to break down the employment numbers that came out earlier today. I was not able to go live because, as I said earlier, I'm still settling into my new apartment in Dubai. So you can probably see, boxes and bags and whatnot in the background because I've just been going back and forth, kind of furnishing the place, installing the Wi-Fi, getting a washer, dryer, like all those things, and basically having my own setup also built. So having a desk and a chair and whatnot. So in this video, I wanted to basically break down the employment numbers and what the heck is going on with respect to the numbers itself, and also break down the interest rate expectations and markets and how they're moving as well. So hope you guys enjoy this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. Again, first week of the month is the best time to join, so we'd love to have you on board if you want to get access to all the members-only private videos, intrinsic value spreadsheets, and of course, buy and sell alerts, options alerts as well. And I do want to mention that this is going to be a long weekend, so Monday is going to be a holiday in observance of the Labor Day weekend. And because of that, we also have our fundamental and technical analysis courses currently 50 to 60% off that you can also take advantage of. And coupon code is going to be Labor4. And this does expire and ends on Monday. So Monday night is when these coupon codes and these discounts expire. So again, you can take advantage of that with the link down below. So when it comes to labor reports, we basically saw unemployment numbers increase by 187,000, right? So we came in at a much stronger number versus the consensus of 170,000. So again, it was a stronger print overall, but the unemployment rate actually ticked higher, right? From 3.5 to 3.8%. Now, a lot of people ask me the simple question, Caddy, how is it even possible for jobs to be added in the month and unemployment rate to also go higher? Because all really matters is the participating population, how many people are participating in the labor market to actually be looking for jobs or already employed, and how many people are currently unemployed in the US. That's what's really important for us to understand why the unemployment rate ticked higher from 3.5 to 3.8%. I'll go over the exact calculation and how it's calculated. So that's the number, 3.8%. It ticked higher. And that, again, suggests that we're starting to see a little bit of softening in the labor market. Private payrolls increased 179,000. Manufacturing payrolls were up 16,000. And the participation rate, as you'll notice, went up from 62.6% to 62.8% as well. Average hourly earnings up 0.2%, and average hourly earnings year over year 4.3% as well. So if you come over to my spreadsheet, which I have again broken down in the past, I've talked about this very, very important metric for us to look at, which is the unemployed persons. That I think is a far better metric to look at than anything else. This is the great inflation of 1970s. This is the dot-com bubble of 2000s. This is the great financial crisis of 07-08. This is the COVID pandemic of 2020. And this is where we are currently as of 2023. So I'm just going to put down current at the moment. So what you'll notice is obviously during the great inflation, what we witnessed was the unemployed persons, this right here, the one in orange, spiked to over 11.3 million people were unemployed during that time. And obviously the participating population was very, very low back then. It was only 105 million because participating population is basically taking into account the total eligible workers, but then also not accounting for anybody who is disabled or underage. So participating population is people that are actively working or looking for jobs. So 11.3 million were unemployed. Participating population was 105 million. So that calculation becomes very simple. The unemployment rate becomes very simple. That's simply unemployed persons divided by the participating population. And that was at almost 11%, 10.76% at the peak of the great inflation. The dot-com bubble, the situation was actually not that bad as what many people seem to believe. Of course, the stock market was getting destroyed, down over 80-90%, but the economy was actually not that bad. 6.2% unemployment rate, 8.5 million unemployed persons, participating population back then about 137 million with over 60% participation rate, and that brings us to a 6.2% unemployment rate. Great financial crisis, also not as bad as the COVID crisis, which was a little bit over 14%, because during COVID, so many businesses got shut down, so many people lost their jobs, that we had over 23 million unemployed persons with over a 14% unemployment rate. So right now, the unemployed persons, this metric has moved up, and this is a more important metric than anything else. So if you come back over to our presentation here, we're going to come back to this. This is basically telling us the job gains and the losses for each industry. But this right here is the unemployment rate, which again ticked higher to 3.8%. But more importantly, this is the metric, which is civilian unemployment, right? Total number of unemployed persons, 6,355, and this is in millions, or actually in thousands. So we're looking at 6.355 million people. So if you plug in that number over here, total new total unemployed, 6.355, what you'll notice is that the unemployment rate, look what happens, right? It jumps up to 3.8%. You see that happen, right? If I put down 6, it's at 3.6. If I put down 6.36, which is where we are now, 3.8%. That's what happened going from 3.6 to 3.8%, is that the new total unemployed persons basically increased. And not to mention that we also got the JOLTS numbers earlier this week, which was at 8.827 million. So unemployed persons now is going to be 6.355. And now we're looking at a ratio of 1.39. Now this ratio has come down substantially, right? So I mean, at one point, I remember we were at 4 million unemployed persons with about 12 million job openings. So this right here was that metric that Jerome Powell always quoted. And he was like, there's 2.5, close to 3 jobs for every 1 person unemployed. That was true, but guess where we are now? This number has softened down to 1.39. So we're very getting close to 1. Of course, below 1 is going to be a much worse situation, because let's say that unemployed persons continues to start increase. Let's say that we go up to 7, right? Or we go up to 8 and we go up to 9, and see what happens is that ratio that starts dropping, right? That basically is telling us that there is definitely weakness in the labor market, and especially if companies, so this is basically companies, this is basically individuals. That's how you should see it, because JOLTS represents the company's listings and how many people actually job openings there are, how many companies are hiring. So if this number continues to go down also while unemployed persons are going higher, then you can start to obviously see that ratio continue to decline. But we're not there yet. This is where we are at 1.39, but this has obviously come down substantially from its highs of 2.5 close to 3. So I wanted to go over some of these things because, these are some of the more leading indicators within the unemployment report that I don't think a lot of people are talking about, that gives us a little bit of an insight as to what's really happening. And if these ratios continue to drop, if participation rate continues to increase, unemployed persons continues to increase as well, well, guess what? There is going to be higher chances, higher probability of a recession, which has been postponed year after year, quarter after quarter, but eventually with the credits, with the spreads that are negative, so negative spreads, and of course the yield curve, which is inverted, and there's a lot of other metrics that are also suggesting weakness in the economy, but some are suggesting very, very strong economic growth. So there's been a little bit of mixed signals, but unemployment is the bread and butter of any economy, right? If people are not working, they're not making money, and guess what? If they're not generating income, delinquencies will start to go up. You will see a lot of foreclosures of properties. You will see a lot of credit card debt delinquencies. So it's just not going to be a great situation, and people are not going to spend. If people aren't going to spend, earnings are going to plummet. So it's a kind of like a ripple effect, and it all starts with unemployment. This is, as I've mentioned before, is bread and butter, and it's literally the starting point of any economic disaster. So some of these metrics are very important for us to keep track and understand where we are. So Mohamed El-Erian basically says that, taken at face value, the U.S. August jobs report increases the probability that the high data-dependent Fed will not hike again this cycle, as job gains, including revisions, moderated to 187,000. The unemployment rate went up to 3.8%. Labor force participation edged higher to 62.8%, and wage growth moderated as well. Markets will like all this. It's mixed for the economy. As I mentioned, there's a lot of mixed signals in the economy. And finally, why face value? It is hard to know with confidence how best to adjust some of the numbers for strikes, etc. So speaking of We also did have a trucking firm, Yellow files for bankruptcy protection, and that's one of the reasons why transportation and warehousing saw one of the biggest declines of over 34,000 jobs lost in that particular sector. But again, two really important sectors I focus on is manufacturing and construction, and both of them actually gained, construction and manufacturing, both of them up 22,000, 16,000 respectively. So that continues to suggest that the economy is still on a very strong path. And this right here is one of the reasons why we could have a one-off with this labor report. Now, speaking of interest rates, I do agree with Mohamed El-Erian a little bit. However, the Federal Reserve is not going to be focusing on the labor market. Yes, they mentioned softening of the labor market. They need, the unemployment rate, as they've projected in 2023, to get up to 4.5%. We're nowhere near close to that number yet. We're at 3.8, 4.5 is still ways to go. So even though they've projected that number, they've expected softening the labor market, they're still not going to take it easy on interest rates. I think there's still going to be a higher chance that they raise rates, even though the markets are not pricing it in anymore. We flipped once again. The market's pricing in. The Federal Reserve is going to keep rates where they are. They're not going to do any more hikes and basically cut rates 4 times going into 2024, bring them back down to sub 4.5%. So I do still a little bit disagree with the market expectations here. I do think the Federal Reserve is going to look at core inflation, and that continues to be above 4.2%, which is more than twice the Federal Reserve's target. And this is only the beginning of the softening of the labor market, which they've already priced, which they've already penciled in their SEP. So that's where I stand with the entire sort of report. Let me know your thoughts down in the comment section below, and what you make of this labor market report. For me, I think I'm going to be somewhat cautious, knowing that the Federal Reserve can continue to raise rates here a couple more times, maybe at least one more time. But yeah, hope you guys enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Don't forget, first week of the month is the best time to join. You get access to everything, all the alerts, members only videos, intrinsic value spreadsheets, and don't forget fundamental technical analysis courses as well as option scores, currently 50 to 60% off. Coupon code LABOR4, valid until Monday if you want to take advantage of that as well. Have a great long weekend. I'll see you all in the next video.